Welcome, everyone. My guest today is Lead Analyst Logan Mohtashami to talk about all the factors that could lead us to lower mortgage rates, including declines in construction labor. Logan, welcome back to the podcast.
Hello, Sarah. And today's going to be a lovely conversation because what's slow dances since 1971?
The 10-year yield and the 30-year mortgage rate.
30-year mortgage rates. And remember, next time we're going to be on stage and I got that chart out, you're going to have to come on, stage with me. And we're going to do kind of like a Wyatt Earp end of Tombstone dance with the 10-year yield and mortgage rates, from 1971 to go into 2024. And the reason I bring this up is, are we finally seeing the frontline recession risk with construction labor? And the reason I'm bringing this up now, we're doing this on Tuesday morning. And by the time this podcast comes out, housing starts, permits, and that data line will be out. Also, the Builders Confidence Index will come out on Wednesday. And for me, it's always been one of the reasons why we haven't had a recession is that the frontline data lines that always break before the recession hits is construction residential labor. And in a recent interview I did with a Wall Street economist, he asked a very, very good question. And he said, Logan, with new home sales trending at 2018 levels, why is there so much more residential workers? And that's a very fair question. I always talk about, new home sales are below the 2001 recession levels today. What's occurred in this cycle is that we had a backlog. And we have had the biggest backlog in new home sales. And also we had an apartment boom. And it takes a lot, to finish one of those projects, 21 months. So we have a backlog in two different sectors of the residential construction. And also remodeling work is much more. Not just people's living in their homes longer and longer, but, you have people that, fix up homes and, sell or rent them out. So because of that, residential construction workers is still growing. But if I just took out the 5 units and the remodeling, we've had a downtrend in residential single family workers. We haven't gotten back to a cycle high or growing there. So the builders have enough to get things done. But for the first time, and we'll know this when this podcast comes out, we'll get the housing starts data. Permits are falling for single family and multifamily together. And one of the things I brought up with another economist this morning is that active inventory, completed units for sale, 98,000. It's not a lot, in the general senses or when we think about total active listings. But for the builders, what are the builders? What are the builders not, Sarah?
The builders are not the March of Dimes. They're not a charity.
They are not the March of Dimes. They are not a charity. They are here to make money, and the excess money they have, they're going to put it for stock buybacks. So don't ever think they're just going to go full-blown housing construction because it'll ruin their business model and profit margins. And the builders have excess profit margins, and they've been using that to pay down rates. If that didn't happen, we'd have a much different conversation today. But now, with total active inventory, which is 98,000, not a lot, that's above pre-COVID. Smaller builders don't have as much luxury as bigger builders, and multifamily permits are down. So even though the last few months, residential construction workers have been creating jobs, you could finally see the frontline data that could possibly be recessionary in terms of getting jobless claims up. Now, why is this important? Because what does the housing market need? The housing market needs lower rates, right? And what does the Fed need? The Fed needs labor market to break. There's a bunch of Fed presidents speaking today, and one of them said, there's really good inflation data, but we know higher rates are working because labor is, the labor market is getting hit, right? And retail sales came out as a miss of estimates, and the revisions were negative. But if you look at retail sales, it hasn't really gone anywhere up or down in any big fashion for some time. But if single family permits keep falling, multifamily permits keep falling, and this is the key, when the completed units of multifamilies gets done and you get more single family completions, the builders are not going to be laying down a lot of new work, right? So that in its sense would retract residential construction workers. And then if the remodeling sector gets hit as well, that would be your frontline data for jobless claims to rise. And we always say when jobless claims rise, when they head toward 323,000 4-week moving average, there's a recession. We start going in that direction with all the labor data that we have now. And the Fed has kind of thrown in the towel with some of the other people say, okay, we're not tight anymore. This is pre-COVID level. So you put that together, there's your lower rates. And what happens is that lower rates will disproportionately benefit the housing market, especially existing home sales. And before we had single family permits rising and we had the builder's confidence rising. So now we're going to get two pieces of data by the time this podcast is out, where the permits are and where the builder's confidence. Now the builder's confidence is tilted towards smaller builders, not the big publicly traded builders. So you put them together, you connect the dots. This is the first time in a while now that we've had, if single family permits keep falling, you could get to that direction. And that's something to keep an eye on. And my thing is that my concern is that we're starting to see that the disinflation in apartments in some areas have already gone away and it's starting to pick up again. And we already have permits at COVID-19 recession lows. So you can't ramp up. And as we can see, it takes 21 months. So we'll see how this goes, but we could finally, remember, my job is to connect the dots, lead the pathway, right? I could tell you why the recession hasn't happened, and I could guide you to what recessionary data is, but this is something that we'll keep an eye on. And maybe single family permits bounce up. Rates have come down a little bit now. As I talk to you, the 10-year yield is, 4.21%, but it's something to focus in the future, because to me, the number one thing for housing, especially now that inventory's up, they need lower rates to grow sales.
It's so interesting that what would help housing is lower rates, and lower rates are tied directly to unemployment. Unemployment is one of the biggest sectors is construction workers, which is back to housing, right? So it affects us in a lot of different ways as mortgage, real estate, what happens in this sector. We'd be talking about this even if we were, not in housing, if we were concerned about rates, because this is directly how the Fed is going to say they want to see labor breaking. That's going to happen in this construction sector at some point.
I wonder deep down inside if they weren't frustrated, right? If they just sat there and go, wait a second, the housing, because Neil Kashkari keeps on saying the housing market is resilient, and we're like, homie, it's like the third calendar year of the lowest home sales ever. What are you talking about? Maybe he's saying, God damn it, the construction workers aren't being fired yet. Maybe that's the thing, So that would make sense to me. If I'm Neil Kashkari and I want to break the labor market, I'm like, why are these construction workers still being hired? And it's such a unique cycle. I know a lot of Wall Street people are trying to figure this out, but I mean, that's the best explanation I could give, because if you actually look at residential single family construction workers, they've fallen, they haven't really recovered, but apartments and remodeling, that's still growing. So it's something to keep an eye on, and the builder's confidence, we'll see where it is. When the builder's confidence falls and permits falls for single family, multifamily, those charts that I show going back to the 1960s, even before you were born, Sarah, there it is. That tends to be very recessionary.
Ancient.
Yes, like the sea scrolls of the old days, right? So that's something to think about going out in the future, because I could start to see a pattern now starting to be formed. But again, if rates fall down and the builders are able to do this, now the thing is that when the labor market breaks and rates fall down and we can keep the construction cycle going, that's in a sense better for the future. But the problem is that's more for single family apartments or kind of a different story that needs more short-term rates to fall. But in this case, it's something to focus on now, where we have total active inventory units closed, available for sale is above pre-COVID. That hasn't been the case. The builders are, remember, money. They're here to make money. This is not a charity, right? They have shareholders. They got to send the stock buybacks, So we'll cross that bridge, and we'll talk about this on the next podcast, what the data shows. But keep an eye on this going out in the future.
So let's talk about rates for a minute. So this is very, sort of dangerous because we are talking on Tuesday because Wednesday is Juneteenth, which is a federal holiday, and we have off. Maybe some of the people listening to this podcast have off as well. So we are recording this early, so it's always a little bit tricky talking about what's going to happen on rates between here and there. But yesterday I was listening to Marketplace, and they were saying they had an expert on who said something that I've heard you say, which is like the bond market is looking at what the Fed is saying and saying, we're getting ahead of you. Like we don't believe all of this necessarily. And the bond market is taking on some of this itself. So is that why we're seeing lower rates?
Sarah, have you ever seen those slapping contests between men? Where they're like guys holding onto a grip and they just come and just smack you. And then whoever stands doesn't fall down wins.
Yeah, it's ridiculous. But yes.
Okay. The bond market really wants to do that to the Federal Reserve. It actually kind of already did twice when the 10-year yield, remember when the 10-year yield started to go in 2022, late 2022, it got all the way down to like 3.37. And I was like, oh boy, we're going to have to bring out Gandalf the Grey. I don't see this breaking. I don't think we're going to get underneath here because the labor market is the bond market was trying to like smack the Fed in the face and go, what are you doing? You're too tight. We weren't getting a recession. Yields went up higher. Toward the end of 2023, the 10-year yield made an unbelievable move, and that's the history of economic cycles. When the market believes the Fed is done raising rates, you have this really big rally. So it was very aggressive, and then the market was pricing 6 rate cuts, so it was trying to smack the Fed in again. What are you doing? You're too tight. Labor market didn't break. Inflation data, firmed up. 10-year yield went up all the way like to 4.65, and now it's back to 4.21. But the difference now is the labor market is no longer tight. My God, Neil Kashkari said it. It's still tight. Neil needs one of those slapping contest things. No, it's not tight anymore. The quits ratios are pre-COVID. Everything, job openings are broken the long-term downtrend. It's not tight. So in this case, the bond market always will get ahead of the Fed. Why? Because the Federal Reserve is an institution, right? And it meets every 6 to 8 weeks. And a lot could happen in those 6 to 8 weeks. And so if you see, like, for example, let's say the Fed had a meeting and then the next 8 weeks, the jobless claims start to break, 10-year yield will get ahead of it. And some Fed members have talked about this. I know Bullard, before he left the Federal Reserve, talked about, if the labor data or the economy gets to get weaker, by the way, Bullard is now a rate cut ex-Fed member. Whenever these people leave the Fed, they show their true selves. I believe that if the Fed is too late, we'll still have the 10-year yield fall and mortgage rates will fall, and that'll help because housing will get boosted. So in the back of their minds, they might not say this publicly. They're hoping for the 10-year yield to do the early lifting, so then they could assess what's going on and see how much cuts do they want to do or what kind of program or facility and everything in that nature. So we were 0 for 2 on bringing yields lower, trying to call for a recession. Is this the next one? And I would say, like, if the 10-year yield can break under 380 and head lower, that's a material thing. That was kind of like the line in the sand this year. I needed to see more labor weakness, but we're there. It's just that we're not breaking enough on the labor side to get that 10-year yield lower. So the gentleman was correct on Market Watch. The bond market will get ahead. And we always say itchy fingers, right? It's like whenever these headlines come up, like retail sales misestimate, another waterfall dive in the 10-year yield. Like, our jobs beat a water. Bond traders are fidgety, right? They're getting panicked because if you see a cycle rally in yields and this thing is heading lower with duration, you don't want to be offsides on this, right? So that needs the labor market to break. And that's why you've seen these 0 for 2 big moves down in yields and anticipating for recession. Then Fed's going to cut rates, and then who knows what they'll do after that. But it is interesting now how we're constantly seeing these really big moves on any headline, on these algo prints and again, paper, rock, scissors, labor over inflation. we're having more and more Fed people openly admit now, yeah, we have to attack the wage growth. Wage growth is bad, so we'll take that weekly claims data, and then every jobs week now becomes more and more important at this stage, now that the labor market is no longer tight. When job openings were at 12 million and all that, you don't need to worry about that. But now that we're pre-COVID, everything's pre-COVID, we'll get there. And again, another thing is that the unemployment rate, if we just get smaller job gains, the unemployment rate's going to go higher next year or over the next 12 months. Let's just say my 140 to 165,000 model works after we print above 159 million workers. That in itself will raise the unemployment rate over time. So smaller job gains, even though they're job gains, will push the unemployment rate higher going out in the future. The run rate needs about 250 to 300,000. So there's all these things that are going to start to look different. We're trying to connect the dots here, and that's important for mortgage rates, because what the housing market needs to grow sales is mortgage rates. Why? Because it's not like inventory went down. We have more active listings this year than last year.
So let's talk about that inventory for a minute. So on our tracker this week, we got over 620,000 on inventory, which is a lot more than last year at this time, but still, not back to normal levels. So what do you see on inventory? What's the story there?
I had a little chart nerd fest with one of my fellow nerdy people on X, and we were talking about inventory, and the Zillow economist basically said, the mortgage rate lockdown's not really working this year. Oh, did you see that? How the Zillow economist said the lock-in effect is not. In any case, last year, what happened when rates got to 8%, the new listings data didn't go down. That was your call for that's like maybe the historical bottom. So inventory is growing on a year-over-year basis. Be careful of putting too much weight on percentages. I think the total number of active listings is key. Now, I'm happy that I've gotten 3 prints of 11 to 17,000 on our data lines. Okay. I wasn't able to get that once last year. That was not a good thing. So we're getting inventory growth. It's more healthy than anything else. The only problem is like it's Texas and Florida. It's like over 40% of the inventory growth, right? So if you take those two out, and of course they're 2 outsized population states, inventory growth is still a little bit too slow for my taste. And also, I'm not going to get my 80K. This is such a whiff call. I was so sure we're going to get 80,000 minimum peak listings this year. I think 72, 73 was the highest, and I'm literally running out of weeks. This is usually the seasonal peak, for the new listings data, and then we have the seasonal decline of new listings very soon. So that's going to be a whiff call, but considering that rates have now fallen, the fact that we were able to get at least 3 weeks this year of 11 to 17,000 is good. So the growth rate is kind of slowing on inventory. And also the year-over-year comps are going to get a little bit more difficult. So if people didn't remember, last year, it took the longest time to get the seasonal bottom in inventory. It was April 14th. But as mortgage rates started to head toward 8%, the active inventory is starting to grow. So the year-over-year comps are going to get a little bit more challenging to show growth. But it's a little bit slower for my taste lately. I haven't been able to get between 11 to 17,000, but considering that rates have fallen recently, I'll take whatever I can because now I have the buffer, right? So thank you, Texas. Thank you, Florida, for giving a buffer out there. And majority of the country is not back to 2019 levels, but at least we have something here. So when rates fall, there's more product available. A good example, like you said, 621,000. We had 240,000 in March of 2022. No good. That is not what you want. You never want that low of a supply, considering you have, almost 159 million people working in a population of 336 million. But now that we're 6, I know it doesn't seem a lot, but it's a better place to be in now for when rates fall. Because we have to remember, this is the 3rd calendar year of the lowest home sales ever. We're going to have existing home sales coming up on Friday. At some point, rates do fall, or else the economy really stays firm and really is expanding for forever. We're in a better spot. And that's always been my concern since the end of 2020. It's just like, oh, this is not where you want to be. But now at least it might be a little bit too slow for my taste. We have that inventory growth, and we will be in a better spot to deal with lower rates when it's here.
Yeah, I like that context because, the tracker, we always do bullet points that show exactly like, here's where it is, here's where it was. So if you think, okay, so last week, this year, inventory got to over 620,000. Same week last year, 451,000. Same time in 2022, or actually the all-time inventory bottom in 2022 was, like you said, 240,000. That's so low, but normal, right? Active listings for this week in 2015 were like 1.1.
Yeah. That's why when I do the tracker article, the tracker article is not a pure inventory article. It's to show everyone the updates of the weeklies, but it's also to show the 10-year yield, mortgage rates, purchase apps, everything, the economic side put together. And, we'll get the purchase application data update as well when this podcast comes out. Again, lower rates, better demand. More demand means more sellers that are buyers, but it also means first-time home buyers, right? And that's been the thing. A first-time home buyer, those hooligans, those little even creatures, they don't give you a house. They just buy something. This is why I always make fun of the walls. Like everybody, like this tiny percentage of Wall Street or this Airbnb is like the millennials are the biggest home buyers in the world, and they don't provide you a house. They are the evil children of the corn, right? So when mortgage rates go lower, you get more mortgage demand for first-time home buyers, and then that takes the inventory off. So we needed a buffer out there. And if you look at the whole channel work of inventory going back 14 years, you could kind of connect the dots that, oh boy, mortgage demand was rising, inventory was falling, post-COVID or post-qualified mortgage, things have changed. So it is very, very good that we're off those, thank the Lord, we're off of 240,000. Maybe inventory is a little bit too slow for my taste, but I am so happy that I got 3 weeks of between 11 and 17,000 because now rates are not above 7.25 anymore. So that model is different for me. So I won't be surprised as much if we don't get there. So it is what it is. It's the best we could do in the situation. But again, we always have to remember this is the third calendar year of the lowest home sales ever. Right? This traditionally doesn't go on for a very long time. It has already here, but eventually rates just getting down to the low 60s basically gave us a legitimate purchase application data run that'll boost demand and sales. So we're just in a better spot to deal with that next time it comes around.
I'm feeling pretty optimistic at this point. I mean, compared, right? Optimistic because, we're seeing inventory. We do have a little bit more of a buffer, because we do see a path for rates to go down, right? We're not like 3 months ago where Powell was on and it looked like he took all of them off the table for the rest of the year. It feels like the bond market is also getting ahead. So we might see some rate differences, even if the Fed or before the Fed does something. So all of those things to me say we could be setting up for a more positive fall.
Yes. And I always try to tell people, the rate cuts isn't the main story. It's the labor data that pushes the 10-year yield. And I mean, think about it. We've had 2 really big moves in mortgage rates over 1%. And we weren't cutting rates, at that time. We just, the first one was the bond market thought we were going into a recession. And the second one, the Fed stopped hiking, and bond market was over exaggerating to the weakness side. But now the labor market is no longer tight, right? So the dual mandate starts to become in place. So it's a much firmer place to be in now than, let's say, in 2022 to 2023. Don't have to bring Gandalf out right now. The labor market is already softening, has been softening for months. So it's a much different backdrop. And again, the spreads are better. Right? I know people say, no, the spreads aren't back to normal. I know they're not back to normal. There's a lot of downside you could have with rates just for the spreads getting back to normal, but they are better compared to what they were last year. And this is why last year, I still think people did not give the attention to the spreads being bad, because in some cases you could be 0.5% higher today, right now, as we're talking. That's how bad the spreads were last year. So It'll be interesting. I always get this question, well, what if the commercial real estate market breaks and banks go out and the spreads get worse? The counter to that is that the spreads typically get better when the Fed starts cutting rates and going into it. So that'll be a tug of war battle. But we'll cross that bridge when we get there and just be grateful that the spreads are better this year than last year.
Listen, I'm at a real estate event here in Austin. And so they were doing State of the Austin Real Estate Market, which I'll be writing up. And they had, person for retail, office, residential, manufacturing, like across the board, what does real estate look like? And I'm telling you, the office guy, that's a tough business right now, especially in Austin. Right? I mean, it's very specific. So
yeah, well, you had a systemic once in a lifetime event. I mean, we build office places so people could go there and work, right? And if more people are working from home, that means that demand is not there to the levels that you thought, and that's why I say like work from home is like the biggest variable in housing ever that I've seen, that I'll probably see, because it's not only this residential real estate, you can actually move to another city and still have your job. You don't have to be within 30 to 90 minutes of driving distance. You can go to cheaper areas, but also on the commercial side, it leaves a lot of vacancies, right? And, when we think about commercial debt, whatever the $11 trillion, it's office space and multifamily operators that are being hit. Everything else is kind of, holding up. But, it's not like the Fed can cut rates and people go back to work in an office. That's different. So I always say I'm being gracious by saying some of these people are going to sell their properties at 15 to 21 cents to the dollar, and there's going to be a lot of losses taken. And then when debts are due, the Fed's are going to have to merge these banks together. The Fed has proven that they have ways and tools to mitigate the damage out there, but we'll see what happens to the lending side of things, especially if more regional banks have to get merged, or if they do get merged and the bigger banks have good balance sheets and they can start lending, maybe their lending facilities get a little bit better once they get merged into, but there's going to be losses. There are going to be banks that go under. It's going to take time, right? I think a lot of people just thought it'd be happening fast, and it's just not that process.
I think in Austin specifically, right, the kind of businesses that were attracted here in 2020 and built big offices, around that time, Oracle comes to mind. They are also the kind of businesses that have been the slowest to bring people back to the office, or maybe those people will never come back to the office. So a very specific market, but also that commercial, defaulting on loans and consolidation will be one of the variables that we'll look at, just like we had that last year. So Logan, thanks so much for being here.
I always tell people that, there's a lot of like major doomsday theories on commercial real estate, but just keep this in the back of your head. Not that you will, because you guys are all normal people and have lives and you're not nerdy like me. If there is a facility program made for losses to be taken, or, the bigger banks will just engulf these smaller ones, and then these smaller ones can basically lend out because they have, somebody bigger with a better balance sheet, that mitigates some of the commercial risk that people think. A lot of people say, oh, this will be a Great Depression, this will be this. But I think the other side of the equation is, property taxes or incomes that cities and states get from these buildings. That's not there. So that's another area that you can maybe dabble into the negative side. But, there are levers that can be pulled where you mitigate the damage and you don't get as aggressive tight lending as a lot of people have thought. You get a big commercial bank like JP Morgan could just swallow three of these, regional banks up, and JP Morgan has enough capital and they go, hey guys, just keep lending. Don't worry about it. We'll take the losses. The Fed will back up some of these things, and yeah, you don't have your company anymore, right? Your company's done, but you work for us. So, then it goes, are the big banks getting too big again or powerful? But whatever it is, it's not always like a 100% Lehman event at all costs. So we'll see. That'll be an interesting discussion once we get into that time frame.
It will be very interesting. Logan, thanks so much for being on, and I will talk to you again in a few days.
Pleasure. And just remember, you're going to have to dance with me on stage. I'm going to refuse to talk. I'm going to refuse to talk. And then everybody's going to be booing at you and get on stage. And we're going to be doing the 10-year yield dance and what drives the 10-year yield. And I'll show you, well, back in the 70s, this happened, in the 80s here, the 90s here. And, and we'll have like all the music, like we'll get the 70s music, we'll get the 80s music, the 90s music, and we'll make it all the way, dancing with all the tunes out there.
Okay, I will be interested to see what sort of event this happens at. I'm having a hard time picturing it, but I appreciate your enthusiasm, Logan, for this topic. So thanks for being on.